So what if you could survey over 2,000 experienced investors that follow the same strategy as you do, that focus on dividend growers, and ask them, what are your favorite stocks? Well, this is exactly what I did with my DSR Pro members, where we have over 2,000 members at Dividend Stocks Rock that they manage, do their research, optimize their allocation using DSR tools. So today I'm presenting you the top 3 Canadian stocks and also the top 3 US stocks that are the most favorite, the most held among those portfolios. If you want to know more about those, you can actually have access to the top 50, so 25 Canadian, 25 US stocks, watching the webinar that I did about a week ago in the link description below. So you just click there, you'll see the webinar recap along with all the questions that I answered after the presentation, and in that I share the top 50 most popular stocks. Why doing this? Well, just to give you some ideas, right? So it's nice to feed up your curiosity, but also get some ideas of what successful investors are doing, and this is what I'm presenting to you today. I'm going to tell you what I like, what I dislike, and the role of each of them in your portfolio, because you know there's no free lunch in finance, and it's important to do some digging to understand if this is a good fit for your portfolio or not. So let's get started with the first one, TELUS. That is the most popular stock at Dividend Stocks Rock. It's held by more than 1,000 members. That's kind of crazy, yeah. Probably because it offers a good balance between dividend growth and dividend income. I did a video a few weeks ago about TELUS explaining you how to track the cash flow from operation, the free cash flow, capital expenditure, and obviously to make sure that all of those numbers are in line to pay and increase a dividend. As you can see on the dividend triangle, it is probably a good time to look into TELUS as the stock price has plummeted from their all-time high in 2022. So that could be something interesting for you guys to dig a little bit deeper and see if it would make sense for you. So what I like about TELUS is its sticky business. Most of their revenues are coming from wireless services, which is quite stable, and let's be honest, we're not going to stop using our smartphone anytime soon, so they're going to continue to generate a lot of revenue from it. I also love their diversification. They decided to make a big play on technology instead of going towards media like Rogers or BCE, and I think that over the long run it's going to pay off, but right now, in the meantime, that is pretty much a flaw in their business model because the investment cycle in technology has slowed down. This means a lot of businesses, they're just thinking, you know what, we see interest rates, we see the economy slowing down, we're not gonna spend too much on technology to improve our business, but rather keep our money in our bank account and see how the storm will hit us or not. So going forward, they will likely have a good recovery in terms of sales. That is something that could slow them down. The other thing I don't really like is the fact that over the past few years, they've been spending a lot of money and the free cash flow does not cover the dividend, and for that reason, they have to borrow more money. At one point, debt is fun, but at one point you'll have to pay it down and you don't want to wait until it becomes a burden, so you have to watch for this when you look at TELUS. Moving on to number 2 on the Canadian side, TD Bank. Well, let's be honest, not a big surprise here that we have a Canadian bank among the top 3. TD is not my favorite, but I do appreciate their classic banking activity. So no surprise here, most of their money is being made by savings and loans. So you can think of like mortgages, commercial loans, traditional savings. It is a very solid bank. I also like their expansion model into the US. 1/3 of their revenues are coming now from the United States. So if you're looking for a solid bank in Canada that has also some growth vectors in the US, you have found the one. Obviously, it's a very strong dividend grower as all the other banks and operates in an oligopoly in Canada. What I do not like is actually kind of the same thing, is while it is comforting to see that this business is a little bit more about the classic banking activities, I think that sometimes it could lack of growth vector. So be a little bit more innovative, a little bit more aggressive on the market, but that's more about my taste than anything else. And obviously their exposure to mortgages in Canada could also wait on their financial results for a few months, for a few quarters, but overall a very solid pick here. The third most popular dividend stock at DSR is the mother of dividend growth with 50 consecutive years of dividend increases, Fortis. What I like about Fortis, well, you know what? This is the type of stock that you can put in a black box, you can bury it in your basement, forget about it for 25 years, and then you pop it up and then boom, it still pays a dividend. That's kind of crazy. 99% of their assets are regulated, meaning that they are operating in small monopolies, 18 different jurisdictions, and they generate predictive cash flow. As you can see, revenue keeps going up, the dividend keeps going up, and the earnings are not doing that bad as well. So it is a model of stability, a predictable cash flow, and it is definitely a very good company if you're looking for a foundational stock in your portfolio. On the other side, obviously, growth perspective are a little bit harder for Fortis. They have to grow by acquisition, and we know that in this field it is capital intensive. They have to disburse a lot of money, and sometimes the integration, it doesn't go that well. The interest rate will weigh on their performance as well, and then at one point some regulators may say, you know what, Fortis, you are not allowed to increase your rate that much because we have to protect consumer spending as well. So overall, a very solid pick. Again, you get a sleep well at night company. A little bit boring sometimes, but you kind of need those kind of boring stuff when the market is shaky, because then you don't have to worry about this part, and this is probably what I love the most about Fortis. Now, before I move on to the 3 most popular US stocks, I just want to take a quick pause to ask you to like the channel, subscribe, and turn on the notification. I report a video every Thursday morning, and it's the only way that I can actually share the wealth and make sure that as many people as possible see those videos. And if you want to know more about the top 50 most held companies in DSR, you can just click on the link description below, where I have a webinar last week. You can watch the replay for free. So you click on it and the video will start right away. So no emails, no nothing. 100% free, and you're gonna have a great time peeking behind more than 2,000 investors with their portfolios. All right, so moving on to position number 1 on the US side, Microsoft. So yeah, surprisingly, low yield, high growth stock. It's probably in design with the philosophy of dividend stocks rock. We have been doing business for the past 10 years, and we have been promoting those low yield, high growth stocks in a portfolio. Why? Because yes, they do not pay your utility bill with those small dividends, but they do provide tons of growth. And as you can see there, the revenue, the earnings, and the dividend triangle is just perfect. Everything is going up all the time. Now you're gonna tell me, but Mike, Microsoft is overvalued, it's rich valuation. It's probably the thing I dislike the most right now, but keep in mind that when I bought it in 2017 at 75 bucks, everybody was telling me the same thing. Way overvalued. Don't bother with Microsoft. Wait until it trades at 50, 55 bucks. Now it's a good price. Well, then it's about to reach 400 bucks now, and unless they make a split, they're not gonna go back to 50 bucks, right? What I love the most about Microsoft is their ability to find growth vectors. I just told you about like TD and Fortis that sometimes they lag of like innovation. Well, for Microsoft, it's completely the opposite. A few years ago, they decided to go all in on cloud. Now Azure is like a very solid business model, growing double digit year after year. Quite impressive. Second biggest cloud service for public as well, behind Amazon. And now recently they have been investing massively into artificial intelligence. A little bit of saga with the with management at OpenAI, like getting fired, going back and forth, but in the end Microsoft is fueling OpenAI, and as long as they have this business partnership together, they will go a long way. Obviously, there will be more than one player in artificial intelligence, and maybe Microsoft is not going to be a winner. So far, they're doing very well. We'll see how it develops. But what I love the most about it is that they can count on their solid software suites to generate some cash flow, and then they can explore other possibilities or other opportunities in other businesses. They recently made the acquisition of Activision Blizzard, which was also a pretty nice move in the gaming industry. Now they have become the third largest game maker. So that's quite a feat for Microsoft. So another playground to play with. So overall, I don't expect that the company will slow down its growth, but obviously this is probably the most important part here. Rich valuation, PE at like around 35, which seems to be a bit high. And that makes Microsoft condemned to report double-digit growth every single quarter. So maybe they're gonna miss a quarter and the stock price will drop, and then you can jump in, but put that on your watch list because this one is on fire. Another one with a very solid dividend triangle, not a surprise here as it is my largest holding and it has been discussed at DSR since 2013, and the name is, you know it, Apple. So Apple, obviously not as strong in terms of dividend triangle as Microsoft. They do generate tons of cash flow with their iPhones, and they still use their iPhone as their main product to create multiple other business income. And this is what I like about Apple. It's their ability to enter in a market. They don't have to be the first, they don't have to be the second, they can be the 10th one to enter in the market, but they enter with such brutal force and a lot of cash flow, then they can master what's happening and then create a great product. The other thing that I love about Apple, it's its ability to always find a new idea, similar to Microsoft. So they invest in different types of businesses. They grow outside of their iPhone, and they try very hard to actually minimize the iPhone's weight on their financial statement, which has not always been a success, to be honest. It's still a huge part of their business, and this is probably what I don't like about Apple, is the fact that there is a limit of how many cameras or how many innovation you can put on an iPhone at this point. So I don't know what's iPhone 20 will look like. Is it going to be like revolutionary or not? And if it's not, well, then they will have to find other ways to grow the business. So short term, not necessarily a problem, but as you can see on the revenue and the earnings, they will go through periods of slowdown as well, because they sell like very expensive products. And yes, it is like with great quality and they have a strong fan base, but on the other side, at one point your budget will speak. So sometimes they will go through some difficult period and it's not as stable in terms of growth as Microsoft. The last thing I dislike about Apple, it's its dependence to China. So we all know about the politic tension. So from time to time, it could wait a little bit on their business model as well. But overall, a very solid company, a cash flow making machine. And this year, I will actually be forced to sell some of my shares because now it has been more than 12% of my portfolio. So I'm going to bring it back around 8 to 9. I'm going to sell a few shares just to cash some profit. But that is just like good management of my portfolio. Last but not the least, an intriguing company, one with a better yield than the last two actually, and it's Abbvie, so ticker ABBV. As you can see, this one is for people that love to be on the roller coaster because it goes up, it goes down, it goes up, it goes down all the time. So for the revenue, the trend is pretty stable, but for the earnings, again, it goes up, it goes down. A lot of saga around Abbvie as well. So what I like about this business, well, obviously it has a very strong pipeline. And when you look at big pharmaceutical, the most important part is what they're going to put on the market next. So when they have like a lot of good drugs that are in trial are being sold right now and they have patents for like 10 years or more, then you know that this business is going to roll. So this is the case with Abbvie. They have a lot of potential going up. And the second thing is their acquisition of Allergen with Botox created a whole new perspective for another business segment and also another way to play around the patents, because Botox has not a patent but a trademark instead. So they bought in a very solid legal department with some innovative, creative ways of putting products on the market. And those are the two things I love the most. What I dislike, well, as you know, if you follow the company, Abbvie has been quite a success story with Humira. It's like biggest blockbuster ever. At one point, it was like 50% of their sales and more than 50% of their profit. But good times are over. Patents have all expired in Europe a few years ago, in the US in 2023, and now they have to compensate those sales that are slowing down from other drugs. It's not happening as of yet. It is like almost covering, but not yet there yet. So this is why you see that the revenues are now slowing down a little bit. The dividend growth rate have also slowed down, so you have to be a bit more careful here. We're still talking about like mid-single digit, which is quite good for a big pharmaceutical, but this is why the company has a little bit of struggle, but still lies on a lot of potential. So on the one side, there's a lot of potential. On the other, it's also a matter of transforming that potential into numbers. They do have a lot of debts at this point as well, due to the acquisition of Allergen that was quite steep in their business model. So as you can see, from 2020 to 2022, the big jump in revenue is mostly the acquisition. Going forward, what I'm going to look at for Abbvie is obviously how the new drugs are being developed and how fast they can recover from Humira patent expiries. So all right guys, I hope that you have enjoyed this video. Don't forget to give me that thumbs up, to subscribe to the channel, and turn on your notification to make sure that you do not miss my Thursday morning video. Every week I report a new video, just having fun doing that. So let me know in your comment, what is your favorite stock? Like, which one is your favorite in your portfolio or your largest position, so we can start discussing about that and probably like provide new ideas to viewers. All right guys, so we're gonna see you next Thursday, and in the meantime, don't forget to stay invested.